Good afternoon, everyone, and welcome back to this Kepler Trust Intelligence Ideas for Your ISA event. In a couple of minutes, we'll be hearing from Ed Kuczma and Sam Vecht, BlackRock, Latin American Investment Trust. The trust has been one of few bright spots in the closed-ended space year to date, with returns of just over 14% as of yesterday's close. Yet still trading on a discount of 7%. As well as capital growth, BRLA offers 1.25% of NAV as a dividend each quarter. And so obviously an interesting combination of capital and dividend. We will be shortly hearing from Ed and Sam. Please keep your questions coming through the presentation. There should be a box to the side that you can see, and the managers will pick those up as we go along. So I'll hand over to Ed.
Great. Thanks, everyone. Thanks for your time and your interest in the Latin America Investment Trust. I'm Ed Kuczma from BlackRock, and I have my colleague Sam Vecht on the line as well. So we want to make this as interactive as possible. Please put your questions in the text box for the webcast here. I'm going to start off just kind of setting the stage of what we're seeing in Latin America with all the moving parts globally. We do think Latin America is well positioned, and these are some of the reasons why. First of all, Latin America, the equities have had a strong start to 2022. The trust is up 14% year to date, and this is well ahead of emerging market equities, down 16%, NASDAQ down 19%, S&P 500 down 12%, and the growth and the positive returns are well spread throughout the countries in the region. Peru up 27%, Brazil up 16%, Chile up 17%. And at this point, with heightened geopolitical conflict, it's really amplifying many of the trends that we've already seen benefiting Latin America markets heading into 2022. And provided that the spillover remains relatively contained, we believe these same trends amped up should benefit the region. And we see 5 reasons why Latin America equity rally should continue. Number 1, exposure to commodities. 2, discounted valuations. 3, the region is ahead of the curve in terms of interest rate hikes, having started hiking interest rates in Brazil in the first half of last year. And finally, we see the region as a geopolitical diversification tool, and is also underowned by global investors. And I'm going to go into some slides on the next pages to further explain these points. Now, when we look at Latin America, the exposure to commodities is quite large. If you look at Peru and Chile alone, these 2 countries make up 30% of the world's copper supply. And after Russia, you can see that many of the LATAM countries on this chart are large producers of both energy and raw materials, and they're large suppliers and export all across the globe. And the higher commodity prices tends to have a multiplier effect and a trickle down. Emerging markets typically are boom and bust economies, and with the higher commodity prices, there's definitely a tailwind. Since the start of 2020, there's been a 60% correlation between the earnings momentum of Latin American equities and commodity prices. And reflecting the region's relatively high commodity exposure, over the last 2 months, LATAM equities have seen a major improvement in earnings momentum, by far the largest gain in earnings momentum amongst emerging market regions. Moving on to the next point, we see the region trading at discounted valuations. With earnings momentum positive and accelerating, we view valuations as attractive, with the region trading at 9.3 times 12-month forward PE, over a 25% discount to its long-term history. With over 50% of the index in materials, energy, and financials, and less than 1% of the benchmark in information technology, the current rotation away from high multiple growth stocks into value also provides additional wind into the sails of the LATAM equity story. On the next slide, we point out that Latin America is ahead of the curve in terms of interest rates. Aggressive rate hikes in several LATAM economies have sharply increased the interest rate differential with the United States and most developed markets as well. In the short term, this looks set to widen further, underpinning LATAM currencies that are among the best performing currencies this year. Higher commodity prices, exacerbated by rising geopolitical tensions in Russia and Ukraine, are also supporting LATAM currencies, bolstering earnings momentum for commodity-heavy LATAM equities, and flows into the region have been robust, most notably in Brazil, where the interest rates, the gap between domestic rates in Brazil and developed markets, is above 10% currently, and this is up from 2.5% a year ago. You can see that from the dark line here on the chart. And what this means is that the currencies, which have been underperformers for much of the last 2 or 3 years, should be strongly underpinned by these aggressive rate hikes. Also, the currency strength and the commodity prices will also impact returns for the trust and for the region when measured in U.S. dollars. And currently, Brazil and Russia have among the highest policy rates in emerging markets. Consensus is looking for higher interest rates going forward, but I think the conversation as the year goes on will be when to expect rate cuts in Latin America to help boost growth, given that the rates have already been aggressively front-loaded higher. The next point that I'd like to make is that Latin America is an under-owned part of the global portfolio. The natural resource heavy Latin America has seen a consistent decline in MSCI emerging market weighting, with the region now accounting for only 7% of the benchmark at the end of February. In contrast, emerging Asia has become increasingly dominant, accounting for almost 80% of the benchmark, with new economy sectors like tech, internet, and e-commerce accounting for a large part of the gains in recent years. Obviously, there's been heightened tensions both in Russia and China, and we believe that Latin America can be a relative beneficiary of flows out of certain regions that have done well and into an underperforming asset class that's set to return to greater prominence given the cheap valuations, strong earnings momentum, and also international flows. I'll end it there and maybe hand it over to Sam Vecht. I see a couple questions that have popped up into the queue.
Good afternoon, everyone. Hopefully you can hear me. And thank you very much for all being with us. And I think it's a really great time to be talking about Latin America. As many of you will know, in terms of some of the other funds I manage, we've had a far more complicated start to the year than we've had in Latin America. And I think it's really quite exciting, the story that Latin America represents, while obviously there's a terrible war going on in parts of emerging Europe, and while probably less talked about, the scale of the declines in Chinese stocks year to date have been almost as significant as those seen in Russian stocks. Latin America, despite its own challenges, has been, as was pointed out several times earlier, sort of an island of relative stability. And obviously there are always challenges in Latin America. We have elections coming up, and that's one of the great things in Latin America. We have a series of democracies, and one of the great things about a democracy is they have elections and they don't always turn out as people expect. That said, we've always promised on these types of calls to try and handle as many questions as possible. So we've already have a few in, and please send them in. First question in: have you or would you consider investing in Venezuela? And the answer to that is we would absolutely consider investing in Venezuela, and historically we have had investments in Venezuela. Currently, there's a really big challenge investing in Venezuela. Beyond any sanctions issues, there's really difficult getting your money out, and we hate investments where they're like sort of the Hotel California. You can check out anytime, but you can never leave. So we would absolutely consider investing in Venezuela, but it would require the current economic and political setup to change a little bit from where it is today. Ed, anything else you'd like to add on Venezuela?
Yeah, I have personally invested in Venezuela earlier on in my career, but it's been a long time since Venezuela was an attractive option for investors, to invest in. The main point for Latin America, that the main movers for us are Brazil, Mexico, Chile, Colombia, Peru. Argentina used to be part of this matrix. It still is one of our options, but it's been less favorable for investing in for equity investors over the last couple of years since their last presidential election. So we're always open to diversifying and looking for new markets to invest in. Currently, there's not a lot of viable options in Venezuela. The closest investment we have towards Venezuela would be an investment in a Panamanian airline that obviously, given the close proximity to Caracas, it's one of their routes, but it's a relatively small part of that airline's operations, but it's the closest thing we have to Venezuela right now.
Next question said, please send in more questions. How much do the improvements in commodity prices trickle down to consumers in the form of better wages, new jobs? Want to start with that one, Ed?
Yeah, very good. So there's a kind of two sides to this coin. Throughout history, whenever there is a large spike in commodity prices, the whole region tends to benefit overall. I'll go back to the slide just showing kind of the exposure and the weightings of energy and materials in emerging markets. And, some of the things that we look for in terms of increased employment and formal job creation is the amount of CapEx spend by these sectors, energy and materials. And I would say that, a lot of it has to do with what we're seeing politically and these countries' ability to accept and invite foreign investment. And we've seen a couple of changes in the political landscape, but I think the underlying drivers of these countries and the economies is going to remain the commodity trade, and that's an important piece of revenue generation for the governments. It helps to keep the fiscal deficits in check, and it provides a lot of royalties and tax dollars for the governments. On the flip side, when you look at Latin America, a great deal of the population is at or below the poverty line, and because of this, food inputs and energy makes up a disproportionate amount of their consumption basket. And when we look at inflation, it's rising globally across the board. In Latin America, it tends to hit the most or the least fortunate in terms of income the most. So we do spend close attention to some of the dynamics in terms of CPI and consumer price inflation. I will say that the trends have been pretty positive, though, in the immediate term. Brazil has had 8 consecutive months of declines in the unemployment rate. We continue to see positive formal job creation in Brazil. And in Mexico as well, the employment and formal job creation remains strong. There's also a strong set of remittances from the United States, from friends and relatives that are from Mexico that are working in the United States and send money back home. So we would say that given these dynamics, the current environment is okay. It's kind of a Goldilocks situation, not too hot, not too cold in terms of the labor and employment in Latin America.
The next question, how quickly or otherwise could LATAM commodity exports increase should Russian exports be seriously constrained? And I'll just start off by saying many Russian exports have been seriously constrained. Several reasons for that. Number one, obviously, there are sanctions on various items, but also the ports are very challenged at the moment. The Black Sea is very challenged at the moment for all sorts of reasons. So, and the Russians are also scared of not being able to import various goods and commodities. So Russian exports are very much constrained at the moment. It's one of the reasons why we've seen commodity prices across a range of commodities hit all-time highs or multi-year highs in the last few weeks. And so I guess the question is, can LATAM stand in? For some things, it's very difficult to step in straight away. You can't suddenly grow more soy or wheat overnight. But Ed, any thoughts on that?
Yeah, I think as we've all experienced in recent memory, that supply chains across the world are very, very tight, and it's very tough to bring on, say, new copper capacity, given it takes 2 to 3 years to implement a new project, and sometimes even longer. So I think that, some of the global trading routes are being rewritten, and it might be some lag in terms of delivery of commodities. But I would say when I look at capacity utilization, it already is quite high, and the mines and the metallurgical operations are run quite efficient throughout Latin America. There's very little margin for error in terms of shutdowns and kind of inventories that we see at the ports and at the end users' stocks from the data we have. So I think it is just a very tight market in terms of supplying key commodities. It will vary but commodity to commodity, but in general, we do see a tight global commodity market, and I think that benefits Latin America.
Why has Argentina limited agricultural commodity exports? And we're actually seeing greater resource and commodity nationalism globally. And so Argentina is not unique in this regard. So I think the first thing to highlight is there's a real challenge for many countries, just concerned, as I highlighted with Russia, but obviously also countries not at war. There's a real concern that if they export, they're going to have challenges meeting their own needs, either for that commodity itself or for downstream needs for that commodity. Any comments on Argentina? On that?
Yeah, Argentina is a heavy exporter of soft commodities, and Argentina is also dealing with a bout of hyperinflation. So any chance that the government can have to kind of reduce or limit price increases in the domestic market is one they look to take advantage of. And as I pointed out before, the food portion of the consumption basket is greater in emerging market consumers. So at the margin, given the spike we've seen in wheat prices and also the concerns we would have in terms of, say, fertilizer availability, given that a lot of it comes from Eastern Europe, these are reasons that we're seeing more of this resource nationality coming through, both for strategic and national security concerns, and also to help dampen CPI inflation.
Okay, I'm going to skip one because I can answer the next question very easily. Do you have exposure or invest in unquoted or private market assets? No. All our stocks trade every single day, and we have no exposure to unquoted assets. Going back to the question before that, what examples could you give of improving ESG in LATAM over the last 12 months? And this is a very big focus for BlackRock, for the board, and it's always been a significant focus for us, but it's been an even more important focus for us in recent months and years, and something that Ed has been devoting a lot of time to. So he could probably wax lyrical for hours on this, but try and limit your answers just to a few minutes, if you could.
Okay, great. Yeah, so I think ESG, it's obviously Latin America with a heavy weightings towards mining and energy. It's going to under-index versus other regions in terms of ESG. And that's simply because a lot of these industries are dirty industries, high carbon emitting industries. But with the intense focus, I think a lot of these companies are looking to become efficient in the way that they emit carbon or offset their carbon balance. They're always looking for ways to conserve water. And these are areas increasingly in the spotlight. It is also, rising or increasing the cost of doing business. So a lot of these new technologies and recycling wastewater or becoming more efficient in terms of carbon emissions, it's going to lead to higher costs, which will also kind of lead to higher commodity prices on the other end. But for us, I think the biggest area of improvement that we ask the companies we invest in to focus on is their level of disclosure. There are a lot of companies in Latin America that are doing the right things and making positive efforts to improve their ESG standing and reduce their carbon footprint, but they just don't report it in a way that's easy for us as analysts to analyze and track how they're improving over time. We want to make sure that these companies have targets that are achievable and not just long dated targets out to 2050 that no one honestly could really care about, because the managers that are making these targets aren't going to be around in 2050 to see these come through. So we want to see immediate targets to improve the efficiency and reduce the carbon footprint. And we've seen a big improvement here. I would say like some examples that in sectors we can point to that myself and my team are heavily involved in terms of raising awareness and improving the reporting standards has to do with protein processors like your beef packing companies in Brazil. One of our concerns has been increasing encroachment on the Brazilian rainforest in terms of cattle ranchers or even in the mining industry, raising the land in the Amazon for commercial use, and we want to see better traceability of where they source their raw materials and make sure they're not participating or enhancing the devastating effects that we've seen on the rainforest. So that's just one example, and because of some of the answers we've gotten from the companies and their responses, we've actually excluded investing in those companies for this specific reason. So we do take this very seriously. We want best-in-class practices, and we think we're slowly getting there, but a lot of work is left to be done.
I don't want to have to do this, Ed. I'm going to have to rush you because we've got a lot more questions coming in now. So we're going to have to make our answers a little briefer. And mine obviously can be longer, but yours have to be short. What is, something just happened to the system. What's your view in the fintech sector in Latin America? Another area that you spend a lot of time on.
Yeah, it's fintech. I think there's obviously this leapfrog effect where you can take kind of best practices and developed markets and bring them down and tropicalize them to Latin America. A lot of them are coming in the financial sector, and we've seen actually a great deal of failures because it's really easy for companies to raise money, or at least it was in the last couple of years. And simply lend to new consumers, and we see it's very easy for new banks to lend out cash, but they've had a pretty bad history in terms of collecting them, and we've seen a couple of blow-ups in terms of inexperienced lenders who think they can jump into the lending party and with horrible results. We typically find that the valuations in this sector are prohibitively high. Unattractive, and the expectations are very high once you reach these multiples. So any kind of blemish in terms of the growth, these companies are quick to derate. So we don't have a great deal of exposure to information technology. There are a few exceptions of companies. We have one company in Argentina that's growing, north of 20% every year for the last couple of years, and the outlook remains bright. The main difference between this technology company and others that we invest in is that they're also profitable. A lot of the companies spend a lot of time to burning cash at the onset of their life cycle, and that can't last for long. But we tend to look for profitable technology companies when playing in this sector, and disregard the high value, low profit stocks that haven't done well recently.
Yeah, it's a really important point. Sort of firms that have put PowerPoint before profits, and the way we've often referred to these as as charities. They're not-for-profit companies have done atrociously in the last year. We are very cautious about that portion of the market. Obviously, some companies, as Ed was saying, won't make money initially. But companies that have been around for 3, 4, 5 years and show no sign of making money at any point are probably great concepts. They may be great for the consumer, but they're probably not good investments, and especially not in an environment where interest rates are going up. And in that portion of the market that thankfully we had very little exposure to, we've seen stocks in Latin America and elsewhere fall 70, 80, 90, and in some cases 95% from where they were in February last year. So a real destruction of value in areas where people, as I said, have been focused on stories and themes rather than the bottom line and actually running businesses, which is always what one needs to do in the long term. Taxes are rising all over the world to pay for COVID, from global minimum taxes to VAT. Is that also true in LATAM? I think it's a very true point that at some stage COVID will have to be paid for. And just when we were trying to deal with sort of coming out of COVID globally, we're now having to face one of the most significant wars since 1945. But it's definitely true the fiscal situation in several countries is worse than Brazil, possibly notably so. Ed, do you want to add to the direction for taxation in Latin America?
Yeah, I would just reiterate that the fiscal deficits going into COVID in Latin America were high, and they got even higher given the amount of stimulus that was given. We do see the way out is for higher taxation, mostly on the corporates. Just given the high consumer inflation, there's not a lot of room to further tax the general population. And I would say that, mining and energy companies, given the high prices, are easy targets. So in our models, we do expect higher tax rates, especially for mining companies.
Next question. What about political risk? Is this not the fact that makes the region seem too risky for many investors? It's a very fair question. The very big difference between emerging markets in general and the developed world, where many of us live, is the fact that there's much more political risk. Political risk comes in several forms, not just in the extreme form like war, but also in the fact that politicians may change the rules of the game fairly easily. They may increase regulation or taxation. The fact that politicians can be elected who are very not market friendly or market unfriendly, probably to describe them. So the question is not for us whether there is political risk. Of course, there's political risk. The key question for us is how much of that risk is priced. And if we go back sort of 3 or 4 years ago in Brazil, fairly little of that was priced. Sort of Bolsonaro was early in his time in office, was viewed as sort of somehow the savior of Brazil. Markets spiked. People thought everything was wonderful. And political risk wasn't priced, and there should always be an assumption of a degree of political risk. And now it's kind of exactly the opposite situation, given how much valuations have come down, as you can see on the slide just put up now by Ed. Valuations at multi-year lows, and an extreme amount of political risk is priced. So there's obviously, as I said earlier, an election coming up, and the outcome may initially not appear to be favorable for investors. It's obviously a matter of political opinion as well as financial opinion. So the key question for us at any point is how much risk is priced, and it strikes me that quite a lot of risk is priced today. The most dangerous thing, most dangerous time to invest in emerging markets is when everyone thinks, oh, this seems a safe play. There's a long-term story here that means we can ignore political risk. That's never the case in emerging markets. A lot of risk is priced now. So we can never be comfortable. We always have to be cautious. We always have to look and follow developments closely. But with valuations where they are, a lot of risk is already in the price. Ed, anything to add to that?
I will just add that we've already been through a great deal of the political cycle in Latin America. Peru had an election last year, Chile as well, Mexico, we're kind of in the middle of the presidential term. The big election this year is going to be in Brazil, where the polls, it kind of has a kind of a clear view of who the front runner is. So it gives us a little bit better ability to kind of gauge what the next president might bring. But just reiterating what Sam said, we usually look for politically induced volatility and subsequent sell-off as a opportunity to buy, assuming that there's strong checks and balances between the president and whatever Congress is on the other side. That tends to thwart any radical reform that might bring down the strong institutional framework that these countries have developed over the years.
Views on the impact of cryptocurrency as legal tender potentially spreading more broadly across Latin America. I assume the questioner implies from El Salvador. Personally, I think it's highly unlikely that many countries follow the lead of El Salvador. Ed, anything else to say on that? It's not an area that we're particularly keen on. And I said earlier, the question in an environment of rising rates, that may not be great for the broader cryptocurrency spectrum. Ed, anything else to add to that?
Yeah, we haven't seen much of an initiative for major Latin American economies to adopt cryptocurrency. There's some talks of starting up some exchanges. There's some demand from parts of the population, but it's not an overarching theme that we think will be impactful in the near term.
Good. Next question. How linked to EU-US economic growth is Mexico? In a word, very. In more than one word, Ed?
Yeah, the correlation between the U.S. industrial production cycle and the Mexican economy is very high. You have, I think, an emerging trend that I think will benefit Mexico, which is this nearshoring phenomenon. Given the heightened geopolitical tensions, a lot of multinational companies are looking to diversify their supply chains and also bring them closer to their large consumption markets. So we see there's already a large investor base and foreign direct investment coming in from the automotive sector, from pharmaceutical, drug production. We see a lot of, data centers being starting up in Mexico, given the access to kind of cheap land. And also one of the benefits as well for Latin America and Mexico in particular is the low-cost labor advantage. There's a great deal of highly productive, skilled labor at a lot cheaper prices in the north of Mexico than you'd get probably elsewhere in the world. So we do see Mexico as a beneficiary of nearshoring, and also from what we see as currently a strong economic outlook for the U.S.
The gap between the minute at which questions have been submitted to the current time has now grown to 13 minutes. So we better speed up. We're now the questions being submitted at 1:18 London time. How are the balance sheets of portfolio companies holding up or performing over the last 12 months? Ed?
I would say the balance sheets for the companies are really some at the strongest point I've seen throughout my career. I started investing in LATAM in 2004. And a lot of the companies, they took advantage of the low interest rate environment that preceded the current environment now where rates are rising. I would say also the access to capital markets in the past couple of years was strong, with a great deal of IPOs coming to market, specifically in Brazil in the past year. So this has helped to improve the balance sheets. I would also say, like, coming out of the COVID crisis, a lot of the companies were very conservative. They prioritized having access to liquidity and high cash balances. So as we go into from one crisis to the next, Latin America is relatively well structured in terms of balance sheets, and we haven't heard of any corporate blowups in a relatively long time. So I would say it's healthy at the moment.
Famous last words from Ed there. I look forward to going back to my desk and seeing what happens after this call. Lula seems well ahead in Brazil's polling for the October presidential election. Is this a concern for markets vis-a-vis business-friendly policies? So what I'd say to this is there is a natural tendency globally for people to be very fearful of left-wing candidates ahead of elections. It's fairly clear that Lula has moved somewhat towards the center in terms of the people he's associating with, and it seems to be not quite as radical as business unfriendly as some people have made him out to be. But obviously, the proof of the pudding with all politicians is not what they say before elections, it's what they do once actually in the presidential palace or actually in power. And that's true globally. It's very easy to make all sorts of promises to the left, to the right, and to everyone, promising them everything under the sun. And I think the history with various politicians sometimes is there's some very big differences between their first and their second terms in terms of what they're doing. That may be in the history in Brazil as well. So clearly Lula comes from a left-wing background. The question is, you know, are his policies going to be not just about market friendliness, but are they going to be good for Brazil if he does win in the elections? Your view, Ed?
Yeah, I think, Lula, he has his base on the left side of the political spectrum, and the current president, Bolsonaro, has his strong supporters on the right. And the winner of the election is really going to be who can get the votes in the middle. And we've seen initiatives by Lula to move more towards the center, which has actually been, welcomed by the market. So as long as he continues to make these moves, and I think even if he doesn't, I think he's probably learned from his mistakes in the past. Under Lula's previous terms, Brazil had some of its best returns in history. So, I'm not as concerned about Lula. I think there's also going to be a strong offset in Congress. I think it's going to be a well-balanced Congress that can offset any radical reforms, which I'm not expecting.
Right, next question. Energy and commodity prices go up and down. Are there any non-macro driven, bottom-up investment ideas that can drive the trust no matter what the macro? Does tech innovation allow new entrepreneurs to come in and disrupt the incumbent families and oligarchs, etc.? First thing I'd say to this question is that actually finding long-term winners that can sort of do well whatever the weather is a really big challenge in emerging markets. And in fact, the data shows, in contrast to what many people pretend, the data shows that these companies are very few and far between. The number of companies across all emerging markets and also across Latin America that have been able to grow profits year after year faster than GDP is negligible. Lots of companies have been able to grow revenues slightly faster than GDP, but growing profits faster than GDP, let's say for 10 years in a row, is extremely rare in emerging markets, in part because of all the political risk that exists in these countries, and also in part because these countries change much faster than, in many ways, than, let's say, the US or the UK. So just gaining market share for 10 years might not necessarily allow you to grow profits for 10 years because the whole business environment could change. So we absolutely do look for those. They're extremely rare, despite what various people may claim on their presentations. But to Ed, for a more nuanced view.
Yeah, we're always looking for, I guess, structural growth and reinvestment opportunity leaders in our portfolio. And I would say that to this extent, some of the themes in our portfolio have to do with industry consolidation. And we see, very fragmented markets where the top players have less than 25% market share in their sectors. And in developed markets, this is more, it's a very more consolidated market, which gives the companies more pricing power and more scale. And we see, there's some holdings that we have in the portfolio related to the private healthcare sector, the telecom sector, the car rental sector. These are all industries where, say, the number one and number two player are merging together, and they can get the benefits of scale quicker, increase their market share. They have access to the capital markets, which a lot of their smaller, say, mom and pop run businesses that they compete against don't have. So we see these as some of the long-term compounders that we invest in as we look to kind of diversify away from the boom and bust cycles that materials has in our part of the world.
Have big energy SOEs like Petrobras really improved their governance and reduced corruption since the car wash scandals? I would say I don't want to answer about Petrobras specifically, but I'd say in general, state-owned enterprises, all corporates, are on a long journey, moving from generally bad governance to improving governance to better governance. And this isn't something that happens in a nice linear fashion across all these countries in a straight line, but definitely over the course of my career, it's something which we've noticed. Standards in general are improving, corruption levels are falling. It just doesn't happen necessarily at the pace that some people want, and sometimes it's sort of these improvements don't happen really as quickly as we would like. But Ed, any general questions, any general comments you'd like to make on sort of corruption and governance in Latin America?
I would say that that I'm not going to talk about specific stocks, but there's been a monopoly in Brazil in the energy sector, and that monopoly at the direction of the economic minister has been broken up in certain parts. And I think there's further room for this to be broken up and create better checks and balances through competition. We've seen this in, say, the fuel distribution or the gas station segment of the energy market, the pipeline market, the fuel storage market. So I think this is generally good for, say, Brazilian competition in the energy sector, and puts more scrutiny on best practices. And I think that it'll have a kind of a trickle-down effect to better governance going forward.
Any worries over Brazil with the current macro situation in a country with high interest rates and slowing China demand? It's definitely true. We do have concerns, and those concerns have been very much reflected in prices over recent months. Interest rates have gone up in Brazil, which is good. They actually believe in increasing interest rates because inflation is an issue, unlike, let's say, some central banks elsewhere, where they've sort of kind of initially said that inflation is transitory and not hanging around. The central banks, as Ed highlighted earlier, in Latin America are used to dealing with inflation and understand that it's not necessarily as transitory as some people think. In terms of slowing China demand, I think that's going to be a very true story for all areas this year. How China deals with COVID is going to be probably a very big question going forward. Their dynamic zero policy isn't necessarily working too well currently. And, you know, we can see the impact that's having on terms of Chinese ports, probably in terms of that's a really big global story. So it's something we are very much concerned about. But the great thing about Latin America is that these countries in many cases have domestic endogenous growth. And in a world where growth is going to be increasingly hard to find, finding companies in countries that actually can generate their own growth is really important. And Latin America has many of those. Ed?
Well said. Nothing to add.
Oh, good. I've finally got a friend. What's your view on Ecuador, Bolivia, Uruguay, and Paraguay? I don't see any current exposure there. That's totally correct, sir. These markets are typically fairly uninvestable for equity investors. They don't have a very significant stock market. Some of the stocks that are based or domiciled in those countries are listed in the US or elsewhere. We've definitely considered the stocks listed in these countries, but at current valuations, they don't strike us as very attractive. And it's worthwhile highlighting that, you know, just in terms of economic terms, just the sort of state of Sao Paulo, and someone's going to correct me here, is probably bigger economically than all four of those countries combined. Now, I can see people going to quickly play around with their calculators and see whether that statement is actually true. It takes me back to sort of comments I've made previously about sort of one London borough having considered one London constituency having a greater GDP than many countries in Africa. So Ed's going to quickly check whether my statement about the state of Sao Paulo having greater GDP than Ecuador, Bolivia, Uruguay, and Paraguay combined. While he's thinking that, I'm going to ask another question, which is, are commodities cheap or expensive? And we've only got 3 minutes left. Over to you, Ed, to answer that, the entire range of commodities in 10 seconds.
Well, I guess it's, you know, the view is that given the short supply chains and the disruptions we've had and the low inventories, I would say that commodities are probably, to use the phrase, stronger for longer. You know, we are concerned about developments in China. I think that's the #1 driver of demand. We have been kind of shifting our portfolio more towards a U.S.-centric growth and away from a China-centric growth, playing themes in Mexico, say like Mexican cement producers that have access to the U.S. market. We see like some structural demand drivers that will keep commodities like lithium higher for longer, given the shift to electronic vehicles. So yeah, you really have to kind of look at each commodity individually. But I would say that the trend is stronger for longer, in my view.
Okay, 2 final points from me. Number one, we received one question, which I'm not going to read out, about another investment company. We don't comment on other investment companies, whether they be part of the BlackRock stable or not. Secondly, we've received one comment highlighting that Ed correctly said earlier, I'm not going to talk about specific stocks. We don't talk about specific stocks on calls like this for the very simple reason that we may be perceived as pushing those particular companies, and that's absolutely not what we would like to do. We are long-term investors. We love Latin America. We think the story for Latin America is looking a lot better than it's done on a relative and absolute basis for some time. People are gradually waking up to the interesting range of opportunities that exist there. And so I think we've answered all the questions that have been put out there. Ed, any final thoughts from you in the final 34 seconds?
No, I just want to reiterate that we think that, you know, it's been a couple of years of underperformance for Latin America. And obviously the region was not well situated to deal with a global pandemic. But I think now that the economies are opening, the commodity prices are high, the valuations are some of the cheapest valuations I've seen in my career. We're ahead of the curve in terms of the monetary tightening, and you know, currently this region is underowned in global portfolios. I see a number of wins in the sales of Latin American equities that I think will deliver better relative returns and absolute returns going forward.
Thank you.
Great, thanks very much, Ed and Sam, and thanks to the audience for your participation. Hopefully you can join us for the next session, which will be with Tom O'Hara of Henson European Focus Trust. But whether you do or you don't, I hope you have a great afternoon. Bye-bye.